When it comes to generating income, some ETFs are just, well, they're just really good at it. Hold on to your seatbelts, folks. This is going to be a good one. Planning for retirement isn't just about saving money. It's about making sure your money works for you when you finally decide to slow down. It's often about generating a tax-free income stream right out of your TFSA. We will be diving into some Canadian income ETFs that could be powerful tools for generating, well, a steady monthly cash flow. It can be a challenge to combine high yields with stability, but there are some good choices out there that do just that. We are going to assume that you are building your income stream out of your TFSA, which takes the tax considerations off the table. However, I will add that very high yield ETFs do often come with more complicated tax profiles, from capital gains and return of capital to interest and foreign income. And don't forget, of course, those eligible and ineligible dividends as well. It can absolutely get confusing. Holding them in a registered account does make it a more moot point for sure. Obviously, if you do have to hold them in a non registered account, just be aware that the taxes could be a wee bit less straightforward. If you, of course, limit your ETFs to ones focusing on Canadian companies, you can at least remove the foreign income component from the mix. And, well, adding some eligible dividends is not a bad thing because at least you get a tax break on those. A sub to the channel is the complication-free way to enjoy future content. Okay, for today's list, I was looking for ETFs that have, well, they've been around for a minimum of 3 years so that we at least have a wee bit of history. In a couple of cases, they do have leveraged versions that have not been around for 3 years, but I will mention those as we move through the list. Today's list is ranked by their 1 year total return. So without any further ado, let's do this. Coming in at number 5, we have the Global X Canadian Oil and Gas Equity Covered Call ETF. They've got a ticker of ENCC. So this ETF holds a portfolio of Canadian gas and oil companies and then uses covered calls to generate additional income on those holdings. Speaking of their holdings, their top holdings include the NRGY ETF, ARC Resources, and of course, one of my favorites, a Tourmaline. This is one of those ones that does have a leveraged version. So the leveraged version of this has a ticker of ENCL. At the time of recording, ENCC had a price of $10.13, NAV $10.12. Those assets under management, $507.28 million. Looking at their fees, the management fee on this one, 0.65%. Management expense ratio, 0.76%. Now, if you went with the ENCL, that management expense ratio, it jumps all the way up to 2.36%. Looking at their dividend, they have a yield of 15.005%, monthly dividend of 12 cents per share. Once again, if you went with the ENCL, that would increase this dividend yield up to 19.446%. That one is a monthly dividend of 25.5 cents per share. Switching back to ENCC, their 3-year return on investment, negative 12.67%. Yes, oil has struggled, and we can definitely see it in these numbers. Adding in the dividends, total return 26.16%. On their 1-year return on investment, negative 11.30%. Factoring in the dividends, total return 2.01%. 3-year annualized 8.05%. This ETF is going to absolutely fluctuate with oil prices. So its volatility is very much tied to geopolitical impacts on the energy sector. Coming in at number 4, we have the Harvest Diversified Monthly Income ETF, ticker HDIV. This ETF invests in other Harvest ETFs that focus on healthcare, technology, utilities, and finance. It then uses covered calls and up to 25% leverage to enhance those returns. At the time of recording, their price is coming in at $7.88, and they have an NAV of $7.87. Those assets under management, $402.52 million. Their management fee listed as 0%. It is actually subject to the underlying ETF fees, and you can see this all coming to play when you look at their management expense ratio, 2.47%. The yield on this one, 11.201%, monthly dividend of 7.4 cents. Their 3-year return on investment, negative 8.05%. Factor in the dividends, total return 21.30%. Looking at their 1 year return on investment, negative 1.50%. Adding in the dividends, we do get a total return of 9.53%. 3 year annualized on this one, 6.65%. This ETF probably has one of the more broad diversifications on today's list, and it will absolutely follow the overall market trend. So if we do go into a recession, this is one that will lose some value for sure. However, keep in mind, with an income portfolio, it's not always about that value. It's about the income, and that income is it looks to be pretty steady. All right, coming in at number 3, we have the Hamilton Enhanced Multi-Sector Covered Call ETF, a ticker of HDIV. This ETF, they invest in a diversified portfolio of sector-specific covered call ETFs that are aiming to mirror the sector mix of the S&P TSX 60. They also use roughly 25% leverage to help enhance the returns even further. At the time of recording, their price is coming in at $16.71, and they have an NAV of $16.68. Those assets under management, $623.71 million. And switching to their fees, their management fee, it's listed at 0. And their management expense ratio, this is what we want to look at 2.67%. Looking at their dividends, they have a yield of 12.298%. Monthly dividend of 17.2 cents per share. On their 3 year, that return on investment, 3.66%. Factor in the dividends, total return 35.85%. On the 1 year, return on investment 2.83%. Adding in the dividends, total return 15.48%. I'm liking this one. I'm liking this one a lot. That 3 year annualized 10.75%. This ETF has done, well, it's done quite well for sure. And it is a great way to gain some Canadian exposure at the same time. All right, in our almost top spot at number 2, we have the Harvest Equal Weight Global Utilities Income ETF with a ticker of HUTL. This ETF does provide you with some really good diversification of the global utility sector. It also uses covered calls to add to the income of this fund. And of course, if you're looking for a little more risk, there is a leveraged version of this one with the ticker of HUTE. At the time of recording, HUTL has a price of $17.98. Their NAV, $17.93. Those assets under management, $285.8 million. Looking at their fees, their management fee comes in at 0.50%. Management expense ratio, 0.68%. If you do go with the HUTE, that management expense ratio, it does bump up to 2.25%. Looking at their dividend, they do have a yield of 8.06%. That's a monthly dividend of 12.2 cents per share. If we look at HUTE, that yield does jump up to 9.806%, and that one's a monthly dividend of 8.8 cents per share. On their returns, 3-year return on investment, negative 6.98%. Factor in the dividends, total return 14.30%. Their 3-year absolutely impacted by those aggressive rate hikes. Of course, utilities don't like it, and we can see that in the numbers for sure. Definitely a different story when we look at that 1 year. Their 1-year return on investment, 11.61%. Add in the dividends, total return 20.63%. 3-year annualized 4.56%. Utilities are definitely set to be, well, they're set to be a strong sector as we go through this recession. They are a recession-proof sector, and I have high expectations for them as well. In our top spot at number 1, we have the Evolve Canadian Banks and Lifeco's Enhanced Yield Index Fund with a ticker of BANK. This ETF, they invest in the big 6 Canadian banks, the big 3 insurance companies, and, well, also Power Corporation of Canada. They do employ covered calls and modest leverage to the mix to generate some additional income. At the time of recording, their price is coming in at $7.63, as well as their NAV, $7.63. Their assets under management, $412.50 million. Looking at their management fee, that comes in at 0.60%. We do not have a management expense ratio for this one. Switching to their dividend, they have a yield of 16.645%. It's a monthly dividend of 11 cents per share. On their returns, their 3-year return on investment comes in at negative 4.51%. Factor in the dividends, total return 33.89%. Looking at their 1 year, that return on investment, 7.92%. Adding in the dividends, total return 24.47% on their 3 year annualized. That's coming in at 10.22%. With the economy set to not do so well over the next couple of years, the Canadian financial sector, well, they do have a lot of resilience. The banks, for example, they have a lot of loan loss provisioning set aside, not just for mortgages, but other defaults as well that are related to tariffs and the economy. This is a sector that I have a lot of faith in. I do have a lot of faith for sure. So I have a feeling that this one will do well. I think the income, absolutely safe, and that's the most important part for sure. Okay, I do like this list, but there are definitely some great ETFs that could have been added to the mix for sure. I would love to hear, well, I'd love to hear what your favorites are below, and maybe they could make it into a future list. If you are interested in any of these ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on Canoe EIT. Thank you for watching, and I will see you in the next video.